Thank you all very much for joining us this morning. My name is Steve McMenamin. I'm from Indian Harbor. I'm your host for today's event, which is part of the ongoing series of the Greenwich Roundtable. And before we begin today, I'd like to thank Kevin Mirabile of Barclays Capital for underwriting today's session and for his good work on our Best Practices and Education Committee. Before we begin, Kevin, would you like to say anything to the members?
Thank you, Steve. We're very pleased to be sponsoring today's event. I think by the turnout and the request for attendance, it's going to be quite an interesting one and consistent with the type of quality and the type of presentations we've seen here before. So without further ado, turn it back over to the panel.
Thanks, Kevin. Our topic this morning, behavioral finance, psycho-emotional perspectives on investing, is a topic we first visited in June of 2000. For those of you who were in the room that day, you'll remember our panel revealed these insights. I'll read to you from the transcripts. The news media is an amplification mechanism. It is fundamental in this speculative bubble. They are in the business of attracting attention. The human mind responds more to storytelling than to abstract data. Anxiety and self-esteem are two of the most disruptive emotions affecting investors' holistic decision-making framework. And finally, the major element in the crash of 1987 was a downward feedback loop of people's reactions to price changes. And today we hope to hear some new insights from this emerging discipline. And as always, before we begin today, if you'll please fill out the backside of your invitation card so we can learn how to do this a little bit better. And at this point, I'll introduce our speakers. Woody Dorsey runs the research firm Market Semiotics. Market Semiotics provides insights into the behavioral and emotional influences on the markets. Mr. Dorsey has developed a new hypothesis he calls triunity theory. He is also involved in a hedge fund that relies on behavioral research to provide trade signals. Woody is about to publish a book called Behavioral Trading. His insights are original and his strategy is unique. Woody studied economics at Amherst College, and he's never worked for a Wall Street firm. Nassim Taleb is the founder of Empirica LLC, a volatility research laboratory and trading operation in New York. He is a fellow at the Courant Institute of Mathematical Sciences at New York University. Mr. Taleb has worked for Wall Street trading desks such as Credit Suisse, UBS, Paribas Bankers Trust. He's also worked independently on the floor of the Chicago exchanges. Taleb is a vocal critic on the use of naive quantitative methods in gauging financial risk. He's a popular author with dynamic hedging strategies, and most recently his Fooled by Randomness was a bestseller. He is soon to be publishing a book titled Gambling with the Wrong Dice. Nassim earned his MBA from the Wharton School and his PhD from the University of Paris. Finally, to Nassim's left, Robert Shiller is an old friend of the Roundtable and the Reeser Professor of Economics at Yale University. He is a fellow at the American Academy of Arts and Sciences, a fellow of the Econometric Society, a member of the advisory panel for the Federal Reserve Bank of New York, and a recipient of a Guggenheim Fellowship. Professor Shiller believes in the need to fuse interdisciplinary insights of economists, anthropologists, psychologists, sociologists, and historians into investment decision-making. While he's widely published, most of you will remember his best-selling book, Irrational Exuberance, and now just released The New Financial Order, which I trust he'll share with us today. Bob Shiller is the recipient of the Common Fund Prize, a male model for the TIAA-CREF educational advertising campaign, and more importantly, in creating new insights into the frontier of investing. Professor Shiller earned his PhD in economics from MIT in 1972. As you may know, the moderator of the Greenwich Roundtable is Hunt Taylor. Hunt manages the investment portfolio for the Stern family of New York. He's a seasoned veteran in the world of alternatives, and according to Steve McCarthy, was a male model for Van Gogh's Dr. Gaucher. So having antagonized our moderator so early in the morning, please welcome Hunt as he sets the table.
And according to Ken Shore of Kenmar, I'm actually old enough to have modeled for for that painting. I was told a story not long ago about a gentleman who was walking along a beach in Los Angeles. Let's call him Steve. And as he's walking along the beach, the skies part and some golden rays of sunshine appear, and a thunderous voice calls out to him and says, "Steve, you've been, throughout your life, one of my most devout and reverent subjects, children." He says, "In return for your lifetime of service, I'll grant you a wish. What can I do for you?" So Steve thinks for a moment. He says, "Well, I'm a simple man, and here's my request." He says, "Every year, I take my family for a vacation in Hawaii, and it's very expensive for me to fly over there and rent a car every year." He says, "Here's all I want." He says, "Build a bridge from Los Angeles to Hawaii, and that way I could drive there every year without having to rent a car." And there's a pause, and then the voice calls back, and he says, "Steve, I'd like you to think about your request for a moment." He says, "If you think about it, it's a very selfish request. Not only is it designed really just to amuse you and your family on your vacation time, but it's a request that would consume many of the world's precious resources, steel, concrete, millions of gallons of oil. Isn't there something a bit more selfless that you would wish for given this opportunity?" So Steve stops and he thinks again. He says, "Well, okay, how about this?" He says, "I have 2 teenage daughters, and for the life of me, I can't figure them out." He says, "I'll come home in the afternoon, and I'll go to one of them, and I'll ask them, 'Well, let's talk. What's going on in school? What's going on with your life?' And she'll tell me, 'Oh, nothing.' And then she'll jump on the phone and talk for 7 hours." He says, "I'll go to the other one, and I'll say, 'Gee, you look a little upset. What's wrong?' And she'll say, 'Nothing.' And then she'll burst into tears and run out of the room. Maybe if you could help me understand teenagers a little better, I could be a better father to them." What's another pause, and the voice calls out, "Do you want 2 lanes or 4 lanes?" So, I will suggest to the panel that if they offer they're successful at all in helping us better understand human behavior, stay alert, because there's just no telling who you may get a call from. Let me do a straw poll here. How many in this room believe that markets are absolutely efficient? That would be none. 0. How many believe that markets are predominantly or mostly efficient?
Believe it or not. And I'm on a pattern.
Okay. Interesting starting premise.
The devil is in the detail, predominantly. There's something left.
Yeah, I noticed that. Yeah, I get reminded of that every month. Okay. I've been looking forward to this panel. I'm a fan of behavioral finance, and have been for a long time. And I have read the works of all 3 of these gentlemen, including Woody's book, which has not yet been published. So I'm not going to waste any more time forcing you guys to listen to me. The order of presentation will be Woody, then Nassim, and then Professor Shiller. So, Woody, the floor is yours.
Thank you for this opportunity to share some of my explorations in behavioral finance. The ancient Greeks developed a system of medical diagnosis which they called semiotics. In the financial context, the market is our patient, and our occupational hazard is to diagnose market disequilibrium. Our job, essentially, is to diagnose the symptoms or the errors of the markets. Human beings have always been trying to interpret the behaviors around them, whether it was the habits of the woolly mammoth, the exchange of beads, or changes in options volatility. My view is that behavioral finance is partly just a rediscovery of our basic competitive motivations, our common sense, and perhaps our common cunning. Contrary opinion, the popular investment philosophy, which predates modern behavioral finance theory, is really quite ill-defined. It's been a convenient catch-all for a variety of perspectives about outsmarting the herd. Of course, all successful investors are contrarians by default. In order to do better than the crowd, one has to be ahead of it. There is a persistent behavioral thread which stretches from ancient human knowledge through the market lore of contrary opinion all the way to behavioral finance. When Homer spoke of wily Odysseus, he was talking about our hardwired human heuristic for trying to outwit our competitors. Plato's famous allegory of the cave is an equally apt illustration of these ideas. The projections of Wall Street continue to seduce us. The herd is still fascinated with the shadows on the cave wall, or perhaps fascinated by the pixels on their Bloomberg screen. Adam Smith, the pop star of economics, also known as the invisible hand man, came by his behavioral ideas from the physiocrats and the philosophes of France who preceded him. These ideas have always existed and have always been borrowed or passed on precisely because human motivations are immutable. There's no difference between Adam Smith's invisible hand, John Maynard Keynes' animal spirits, and the idea of a Mr. Market. These are all descriptions of the same mysterious motivations of man in the marketplace. Let's fast forward to Kahneman and Tversky, who are referred to as the prospectors, since they mined the early behavioral ore. Their prospect theory officially initiated the study of economic man rather than of economics. When we study man, we suddenly enter the realm of psychology. Behavioral finance is not about price-to-earnings multiples or the behavior of distressed securities. Rather, it is about the study of distressed securities traders, of whom I think we've all been from time to time. To paraphrase the ancient dictum of man is the measure of all things, we might say man is also the measure of all markets. Thus, any and all information regarding man, from anthropology to perhaps even zoology, may provide new fodder for behavioral finance. We can send a man to the moon and we have mastered the genetic code. We have language, mechanics, and knowledge of these things. But please tell me or show me any equally precise language, mechanics, or knowledge of the market. It doesn't exist. We are woefully in the dark about markets, and teenage daughters in particular. This is the dirty little secret of the dismal science. There is no cohesive economic science about making money in the market. Robert Rubin said, "Everything I have experienced suggests that at core, economic conditions and markets are grounded in the human psyche." That's Robert Rubin. The reason we have so little experience, so little expertise in markets is because of the persistent denial of the psychological component. We have been taught to believe that markets can be understood from a purely rational perspective. We are, in fact, all primarily steeped in a Cartesian conceptualization of financial culture. René Descartes came down rather heavily on the mind side of the mind-body problem when he concluded, "I think, therefore I am." This may explain in part the preference for rational markets. Perhaps the peak in this one-sided cognitive concept of efficient markets and man as a purely rational economic robot reached its acme in what I called the wrong-term capital hedge fund bubble, in which the best of the mathematical rationality team managed to lose the majority of their investors' money. If that didn't signal the end of the efficiency era, the dot-com bubble, which I called e-greed, certainly did. So how do we proceed? New strides in behavioral finance, in my view, lie in the direction of cognitive science. My research initiative has been to look at the cognitive structure of man as a guide to the markets. And the primary fact of cognitive science, and the simplest one, is that man is composed of three distinct brains which perform three distinct functions. Now, market analysis to date has generally mirrored the bipolar duality of Descartes. There are the fundamentals on one side, very definitely opposed by the technicals on the other side. Something may be missing. The missing link is what I have coined as the psychologicals. The psychologicals are how we feel about the market. This is quite distinct from the fundamentals, which are what we think about the market, and still distinct from the technicals, which are how we act in the market. We are all rational people, are we not? But we are also all irrational people. And we are also all instinctive people. These three functions are as present in markets as they are in man and are in a perpetual interplay. My innovation, which I call Trinity theory, is a reflection of these three components. Now, the idea of irrationality may be considered the pith of behavioral finance. But what is it? For most people, irrationality has a negative connotation. It infers that feeling is taking precedence over thinking, which is, of course, bad. Irrationality is considered fuzzy and unmanageable, unless, of course, we are in love or our market position is suddenly making a lot of money. It's a good combination. Alan Greenspan, our fearless Fed leader, said, "There is one important caveat," it's a quote, "to the notion that we live in a new economy, and that is human psychology, which appears to be essentially immutable." Okay, but why aren't these immutable laws of psychology, whatever they are, in any graduate school curriculum? In order to quantify the psychological component of the market, I have proposed a basic unit of emotion, which I call an emotum, or emota in the plural. I have for some time conducted a polling process which very simply collects positive and negative emota from about 100 listening posts, which represent what I call the semi-professional cast of investors. This sentiment database is the source for various semiotic sentiment studies. A white paper which Andreas Kalianos and I wrote, and are happy to share with anyone in the details, shows how a very simple sentiment model outperformed the S&P 500 by 257% from 1998 to 2003. This is rather amazing. It is hard to believe that such a simple sentiment model could be so robust. But that is the point, after all. We like to believe in complex rational models, and we don't, any of us, myself included, necessarily understand market emotions very well. The sentiment model is based on the observation that price highs and price lows are characterized by quite different correlations between price and sentiment. This goes very much against the prevailing and parochial notion that fear and greed are the only two market emotions and that they are polar opposites. The notion that investors must conquer their emotions is equally absurd. In fact, it is impossible. We are always and will always be emotional. Irrationality rules, and it may have rules. Now, I define fundamentals as being whatever market participants are thinking about the market. These ever-changing fundamental stories may be better described as being transient investment themes. The history of markets demonstrates that the extreme of every economic era is defined by a compelling concept that becomes so simple and so popular that it effectively becomes a slogan. Memetics, which is the study of the propagation of information, provides some insight into this phenomenon. A meme, similar to a gene, is an information code that is transmitted from person to person. The semiotics memetics model suggests that when these transient investment themes enter the propaganda realm, they finally lose their power to attract new investors into their paradigm. This understanding has identified extremes such as the Fantasia deflationary climax in the fall of 1998, the E-greed extreme of 2000, and what I call the equiphobia extreme of recent months. These themes can be identified and measured through what we call a slogan search. For instance, from January 2001 to April 2003, a slogan search for Iraq as a media headline had a negative 85% correlation with the S&P 500. In fact, extreme readings in the Iraq slogan corresponded almost exactly to the stock market lows of last October and in March of this year. Memetics works, and it makes ideas such as information cascades and viral propagations more practical. Now, there are many interpretations of what technicals are. My own definition is quite different than moving averages or chart patterns. The technicals are simply all of the physical facts or vital statistics of the market. All technical systems, from Dow theory to Elliott wave theory, etc., try to answer a simple question. what is the trend of the market? I have made a direct study of market trends, which I call trend duration analysis. When we talk about the persistence of bidders or the exhaustion of sellers, we are all alluding to the physical nature of these attention spans in the market. The duration characteristics of market trends do demonstrate discrete, repetitive trend duration modes. The duration characteristics of market trends do demonstrate discrete, repetitive trend duration modes. The duration characteristics of market trends do demonstrate discrete, repetitive trend duration modes. Yes, the market repeats itself too. The essence of behavioral finance is this systemic repetition of habitual errors. These trending habits are the physical heuristics of the market. In the same way that memes are the metrics of the fundamentals and emota are the metrics of the psychologicals, price bars are the metrics of the technicals. These three functions of the market with their metrics and models, which I call triunity theory, may lead towards a more optimized behavioral finance, which may be able to predict some of the markets some of the time. The invisible hand does leave some fingerprints. The herd does leave hoofprints. The risk to the unadulterated development of the behavioral finance school, however, is that there will be a rapid and probably vapid co-opting of behavioral finance schemes by the street. After all, the rational market era ended up as a pocket-lining paradigm for Wall Street once it was suitably rendered as a buy-and-hold bullish story. Behavioral finance is already at the risk of being simplified and conveniently packaged. There are hosts of behavioral departments working on behavioral ideas which will eventually blossom into behavioral funds of all sorts. So expect to see lots of behavioral shingles blowing in the wind. I say this is the risk, but it is a practical certainty that the language, techniques, and appeal of behavioral ideas, great and small, will be propagated to the herd. After all, one of the behavioral tenets is that we are all herders. We are all hardwired to imitate whatever we perceive as accepted and useful. The opportunity for the behavioral school lies in the higher ground of potential societal benefits, which Bob Shiller will talk about, I'm sure. The issue is the degree to which there is an evolutionary aspect to man as an economic animal. My own view is that the efficient markets era and even the Cartesian worldview was a deviation from a more integrated understanding of humanity. I do think that behavioral finance is an enormous opportunity for an intellectual and practical redirection of how we understand ourselves, and by extension, how capitalism can be both better understood and better managed. How these risks will interweave in the narrative of intellectual history is difficult to say, but there are parallels to the prior paradigms in which the alternative asset industry may be where random walk and the mutual fund industry were, say, 20 years ago. There is much more to learn about both human and market behavior. There are also things that we may never learn about either. So I leave you with this semiotics meme. Observe everything, believe nothing, and invest solely based on the behavioral errors of others. Thank you.
Woody, you made an interesting statement. You said that we are both rational and irrational beings. Can you give me a market-based example of rational behavior coupled with or set against a market-based example of irrational behavior?
Well, of course, there's always an interplay in which one might say, in a certain market situation, that the fundamentals or the psychologicals are overtaking the technicals. In fact, we could look at the recent March low, March 11th. You had what I would say, rather strong, very strong psychologicals,
Right.
which had to do with the fear and the measures that we look at. And you had very strong, you had a very strong meme-based factor in terms of the fundamentals in terms of Iraq. But
Yep.
you didn't have, and what many people expected to have, a technicals confirmation. And that's why that low is what I called a dirty low, because the VIX
Right.
didn't go where it was supposed to go. The
Right.
price bars weren't that.
Right.
So that was a combination where the technicals were really missing.
Mhm.
But on the other hand, what's interesting here is the psychologicals in the very, very short term, let's say this week, last week, are rather robust. Markets come a long way. People are relatively friendly. And yet there's sort of a vacuum medically right now.
Yes.
So these different, in fact, what's interesting, of course, is to see how these different forces are at work. And in very strong trending functions, of course, they're all going to work together, which is why either school, whether you're technical, fundamental, or psychological, can always find a claim to fame in terms of explanation after the fact in very strongly trending markets.
Right. And I'll point out that you predicted and called that low to the day. Nassim, you're up.
Yeah. Before is this working? Before I start my discussion, I want to comment on this. To weave into the discussion about when people say that we're both rational and irrational. Most of the scientific literature recently, and we have to remember that the 90s were the brain decade, the decade of the brain. The scientific literature discovered that there are, in fact, two ways we behave. We have two brains, one that we use in a classroom to give someone an equation, and one that you use while acting. When you go trade, when you react, the heuristic one. And Kahneman calls it,
The neocortex and the amygdala.
No. In the psychology literature, it's called system 1, system 2. In the neurobiology literature, it's more complicated. Like the gentleman said, we have three brains, really. Okay. So it's mostly between the neocortex, which decides on the cognitive tasks, and the emotional part of the brain, which is the amygdala and the limbic part. But let's say I have system 1, system 2. Danny Kahneman went to a conference and asked mathematical psychologists a primitive mathematical question on the spur of the moment, and they could not. Most of them got it wrong, and he said they should have known better, but in fact they knew better. It's just that they used the other brain. My experience of what I call the street smart versus academic smart is that each one of us has two brains. Depends on, you react, when you brake at the traffic light, you say, oh, suddenly traffic light, use brain one. And when you think about something deep, for example, you take a test, you use brain two. And there's very little correlation between intelligence.
Right. Well, this is the basis of the book, Emotional Intelligence.
It is part of emotional intelligence, discusses it. Emotional intelligence is a little old now, 5 years. We're discovering more and more about what drives human behavior and how you have to shield yourself. And that explains why people with high degrees, for example, high degrees in mathematics, when you put them on a trading desk in something very mathematical, behave in a very primitive way. Anyway, so my discussion is not about that. My discussion is about I guess we're about behavioral finance. I don't quite believe that behavioral finance will take many people here to the bank, okay? Because so far we haven't seen much of, many dollars coming from behavioral finance. Someone will give you an example. Oh, well, he went short NASDAQ in 2000. Very nice. But how about the guys who went short NASDAQ in 96? How about the people who went short NASDAQ in 97 are now working pumping gas? Okay, so there is a logical inconsistency in saying markets are irrational. Hence, I am going to perform a coherent trading strategy. It is nonsense. If markets are irrational, NASDAQ 5,000, if NASDAQ 5,000 was possible, why not NASDAQ 10,000? Okay, and a lot of people you hear about now who are the ones who have benefited from a survivorship bias. There are people who went short NASDAQ in March of 2000 because they got in. They read the books, they read those books in 99, okay, so they had some money. But those who read those books went to the bookstore and bought there's like 7 or 8 bookstore books that discuss the tulips and the same stories. And those who read those books in 92, 93 are now out of business, okay? So I don't believe. However, we can use the discoveries of behavioral finance in a bunch of little tricks. I am a trader. I am an empiricist, and I like to see things very practical. Few tricks. So I'm going to discuss these tricks. The first one is that most people don't quite understand the risks they are taking. Danny Kahneman submitted people. I mean, people. Kahneman, he's the guy who started the field, so invariably we have to go back to him. He went and asked people to give him a band for a security prices. Say, give me a price. You know it's going to be 99%. With 99% probability, it's going to be under, and with 99% probability, it's going to be over the lower band. So people would give him that high and low, and for securities, say anything from cattle to the GNP of Turkey to the S&P 500 to anything. And of course, they were off by 15%. The 1% was 15%. So visibly, people have this fooled by randomness in a sense that they tend to think that things are less random than they are, because when you look backward in the past, you see things as being deterministic. There's an illusion. Psychologists know a lot more about the topic than economists, because psychologists study human nature, how we deal with randomness, whereas economists have tried to predict random events, and they're humans, and also economics is not a science that has commanded a lot of respect, particularly in trading circles. So, but psychologists have, they have discovered a few more things about human nature, okay? And so we can use a few of these tricks. And let me, in fund of fund, on hedge fund investing, of course there are some biases, and I'm sure someone will ask me later, because I'm going to abbreviate the discussion with a little graph. Let us say I have this trading strategy. Great trading strategy, and I raise money, and someone sees me here. I have a trading strategy that will make the following. Fail. I make $1 every month. Month 1 you make $1, month 2 you make $1, month 3 you make $1, month 12 you make $1, and then you make a check to buy a new car. Year 2, you make $1, you make $1, you make $1, you make $1, and then now you buy now some car, empty house, and then here you buy a chateau, and then because of course you don't have a perfect shop ratio, and then here you buy whatever, you start accumulating, and then one day. This is not the loss, this is what I mean, period. This is the mark for a period. And then one day, month number 100, okay, you don't make $1. What do you get month 100? You lose $100, okay? Or say $99. So here, you have to write this letter. Dear investor and friend, as much of a surprise to you as they are to us. They're a surprise to everybody. Blah, blah, blah. Well, they happen every 10 billion times in the history of the universe, because it's 186 months. And stuff like that. You can say whatever. This trading strategy is an extreme case of negative experience. Of course, you will suffer some pain here. But look at it. You have 199 months of pleasure, 99 months of pleasure, and 1 month of pain. So here you go to Venice, spend 2 weeks in Venice, unwind, come back, and start from scratch. It's a different story. Okay? So basically, what we have here is a strategy that has 99% probability of making $1 and 1% probability of losing $99. Okay? Now, that kind of strategy, most humans would love, even if starting at the game, they knew that it was a failure. Because the pleasure derived. And then there's another thing, the cognitive bias. After making money for 14 months, 15 months, you start believing your own story. There's, of course, something called moral hazard, because it's not your losses are investor losses. It costs you 30%. So you mail that later. But whereas here, you're making more money for a lot of years. So I believe that there's a class of strategy, non-investing. And I'll go back to Kahneman's statement. He said, most people in the financial market take risk not out of bravery and courage. They take risk because of ignorance about the risks. Ignorance in the sense because their brain cannot believe that this was going to happen. So therefore, people have been constructing packages that have negative skews. Of course, most 99 defense are completely impossible. A package with negative skews is a package where you're hiding all the risk in one narrow pocket, what I call pulling randomness under the rug. All the concentration of randomness goes into one block. And people have preference for these kind of payoffs. Now, if people have preference for this kind of payoff, instead of making $1, why not 50 cents? I'm an empiricist who tested these. All negative skewed payoffs, very rapidly, you generate into a negative expected return payoff, negative alpha payoff. They print alpha. Beautiful Sharpe ratio, they have negative alpha. Okay? And people get sucked into them, and even if they knew the nature of the game, after a while, you make steady income, you say, oh no, this package is great. 1998, no, we'll never happen again. Of course not. No, it was a different time.
Nassim, excuse me, can you sit down so we can record you?
Okay.
Thanks.
I pretty much made my point that people. I mean, it's a very simple point that small odds, when you have a pair, here we have a pair, small probability of losing a lot of money, high probability of making a little bit of money. We have known about the bias in the behavioral literature since in the 60s, when Slovitz wrote a paper that you don't have to read, you just read the title, on the preference for insuring against small probable losses as compared to large improbable catastrophe losses. That was the title of the paper. So you read the title and you get the point that people, you have to subsidize them to pay for insurance against a very large loss. Thank you.
Well, one comment, then a question. I'm wondering when statisticians are going to figure out that the statistical probability of improbable losses are absolutely the worst predictors of the regularity with which they'll occur. I mean, the single worst descriptor of negative events is the 100-year flood. Am I wrong? How many 100-year floods have we lived through in this room? Right? Statistically, maybe we should have lived through one. I mean, have we lived through 7 now at this point? Okay. Just a comment. You made an interesting statement, which is that knowing that a market is irrational doesn't allow you to use the information. You said because NASDAQ went to 1,000, you can't really use that effectively because it could have gone to 10,000. Who knows where it will go to?
It's irrational, yes.
Well, here's a question I would pose you. Why can't you use that information proactively? So in other words, let me refer back to a paper that Bob Shiller wrote. You wrote a paper, I think must have been early 90s, that said speculative investing was a social activity. Now, if we were to look ahead and say, look at the economic conditions, say we have a deflationary problem right now, they're reflating like crazy, this is liable to create an inflationary climate down the road, what works in an inflationary climate, you forward out, this might create a climate where gold becomes popular, and gold could get into a climate where it was desired irrationally. Could you not start to use the same behavioral effect that drove NASDAQ to a ridiculous valuation? Could you not use that information proactively with an excellent risk-reward ratio by switching the risk-reward equation and the mindset with which you apply the information? Yeah, I'm asking.
Okay, yeah, you're definitely asking the wrong guy because
well, then I'll ask Steve.
No. I'm kidding. You're asking the right guy for one reason. I'm an empiricist. I work with very small little tricks that I understand very well, and I get very queasy when I start hearing people talk about irrationality of markets, because I need very specific pockets of irrationality rather than just general irrationality. That's the first one. The other thing is what you're talking about is not testable, in the sense that I can't. Whereas saying that the NASDAQ, saying that if someone traded against rationality or irrationality is a testable proposition, this is not testable enough. Talking about my out of the monies here by saying why people like to sell the small odds, the long shots, is testable, and has been tested in both using econometrics and can be tested using by testing on patients, or in hospitals, or looking at people's brain and stuff like that. It's been tested several ways.
We'll turn the floor over to Bob Shiller, who I might add has a wonderful op-ed piece in the New York Times today, but I'll mention that with a caveat that perhaps the most ardent Republicans in the room may want to skip it.
Actually, that's not true, because I claimed in the article
Yeah.
that this is a Republican. Good Republicans should like. Anyway,
Right. Like I said, this is strictly for the most ardent Republicans.
I'll have to
in the
admit
room,
it doesn't
so-
sound Republican.
But it doesn't sound Republican, is what I meant to say.
So, anyway, I've been working on behavioral finance now for many years, and Dick Thaler and I, who's at the University of Chicago, have been organizing behavioral finance workshops since 1991. You can see them on my website, all the seminars, and you can link to the authors' websites.
What's the address of that website?
Well, you can just indirectly go to robertschiller.com, and then you'll see a place where it says behavioral finance, and click there, and it has all of our. I also have behavioral macroeconomics seminars too. That's another important field. I think that the efficient markets revolution, which came in the 70s, was an important scientific revolution because it brought us a mathematical discipline. It's mathematical finance. For example, we now understand derivatives pricing. We understand capital asset pricing model. These things are important. People in these fields feel threatened they act threatened when I talk to them by behavioral finance. But I've been telling these people they shouldn't feel threatened, because this new behavioral research is exactly what we need in order to apply their insights, because their idealized models don't fully fit the world, and we have to understand how they don't fit before we can use them. So I think that I actually am a proponent both of mathematical finance and behavioral finance at the same time, and I wish that there were more people interested in both, because that's how we make progress. Anyway, I'm going to talk in my brief time about my book, The New Financial Order, and it really is motivated by several things. One of them is behavioral finance. Another one is mathematical finance, which gives us a sense of how to manage risks. The whole capital asset pricing model was a wonderful description of how the world should work. I can't understand why academics thought that it would describe the world we live in. It's where we're going, not where we are. And the other thing that motivates my book is the sense that new information technology, I'm talking about computers and the internet and teleconferencing and all these things, are wreaking fundamental changes in our world. They already have. In the last 10 years, it's been amazing what's happened. And the next 10 or even 20 or wherever years are going to produce fundamental changes in our society, and among them in finance. And the whole finance profession will be transformed. So what I wanted to do in the book is put the three together and think about the future. So this is a futuristic book, and it's not really aimed at portfolio managers, but it's aimed at the finance community a lot, because I'm talking about new products and new ways of doing things that I think are likely to come in the future. So I won't say a whole lot about behavioral finance. It is a theme that both Woody and Nassim talked about, is part of my discussion in my New Financial Order, about René Descartes, who thought that the mind could be rational, and the learning that the brain is really organized into a rational and irrational system, and that's important for human motivation. In my book, I also come to the same theme, but I refer to the what's called by some psychologists now the risk as feelings hypothesis. And I think this is the same thing you were saying, but that people find it difficult to take account of big abstract risks that are not in your face. We're designed, when a wild animal is approaching us, our adrenaline starts flowing and we take a quick action. We're quite reliable at that. But when it's just some vague possibility, we're emotionally difficult to come to, and most people will just keep postponing and not thinking about it. But I think behavioral finance gives some idea of how we can readjust our institutions so that these things are taken account of. Anyway, in my book, I give 6 ideas for a new financial order, and I'll just list them and give some indication. But each of these ideas, in my mind, may sound futuristic or implausible, but I think that things are changing so fast, and it may often be little details. Behavioral finance can make new things possible in an undramatic way. That's often the way progress is. Some invention that, like the airplane, I don't know, this comes out of my head, it wasn't feasible until the right internal combustion engine was ready, and then suddenly an idea becomes feasible. And so I think it may be the same for many ideas, that some little obstacle disappears, and then suddenly things that you've blithely assumed are not possible suddenly become possible. So I give my 6 impossible things. The first one is aimed at the insurance industry. And this is, I think we should create insurance for values, insurance for our ordinary riches, the things that matter to individuals. I talk about livelihood insurance, which is really an extension of disability insurance to cover labor market risk. Okay, so right now you can buy an insurance policy that will pay you an income for life if you become physically disabled. But it won't pay you an income for life if you are an analyst who suddenly got laid off because of the change in that profession, or because you are an auto worker who suddenly gets laid off because a Chinese factory is outbid you. So those are risks that we can insure just like anything else. And I think new information technology, I describe this in my book, makes it more possible. The second thing is home equity insurance in that same category. Right now we have fire insurance, which insures houses against loss of value because of a fire. But we don't have an insurance policy against the house just declining because of changing economic conditions, which is a much bigger risk. And so I think, for reasons I explain in my book, these things are becoming possible now. The second idea is for the securities industry, and it is that we should create new securities that represent claims on income flows. I talked about this many years ago, but I'm coming back to it. The stock market is a market for claims on corporate profits. But corporate profits are something after tax under 10% of GDP. They're not very big. We can create markets for claims on the other 90-some%. And if we do that, we'll have a market for risks that's much more comprehensive and makes many more things possible. For example, it might help with livelihood insurance, because the insurance companies can use this new securities markets to get rid of the risk they undertake by taking on policies. The third idea is for the banking sector, or the lending community, and that is that we should make loans interest contingent on the income of the borrower or on an index of incomes of people in the same occupation or category as the borrower. And this would reduce bankruptcy risk. It's just for better risk management. It's like, this idea goes back to Milton Friedman. Incidentally, he's a Republican. Since I'm a big admirer.
I'm really sorry I brought that up at this point.
Milton Friedman said people should sell shares in their income as a way of reducing risk. And that's basically the idea of changing our lending institutions so that you're essentially selling a share. But he said it's not possible, and he gave 2 reasons. One is public condemnation, irrational public condemnation. Well, I think times have changed, and we're not going to condemn it now. The other thing is, he said, it'd be too costly to administer. How can you track people through their lives? Well, the cost of administering these kinds of things has gone way down because of new information technology. So I think it's time. And I think this thing will start to happen. The fourth idea is for the government, and it's called inequality insurance, and it's a way of protecting the society from a gratuitous increase in the level of inequality. And that is what I talk about in this morning's New York Times. It's on the op-ed page of the New York Times. And I hope Republicans like this idea because they're in charge, and I think they will, maybe. Although all of these ideas sound a little bit futuristic. The fifth idea is intergenerational Social Security. And this is an idea motivated by mathematical theories of finance that in order to apply risk management, you have to look at big risks that are not shared. That's where you get the welfare gains. If risks are already shared, there's not much to be gained. But if they're not shared, you can move. So I think a big opportunity is between the generations, between elderly, middle-aged, working, and young people. And the Social Security system should be reframed on that concept. And the last idea is the one that I get the most opposition to, but I don't know what I get from this group. The idea is for international agreements for risk control. And the idea is that you take world leaders, government leaders, and you give them a little lesson in basic finance, and you teach them about risk management. And so what they would do then is make risk managing deals between countries, just like companies do that. So when George Bush meets with Hu Jintao, the new president of China, the first thing on their agenda would be arranging a swap between the two countries, a GDP swap. And the mathematical theory says enormous social welfare benefits. But they don't even talk about it now. It seems impossible. But I think that as enlightenment proceeds, this will eventually happen. So those are my 6 ideas. And I just wanted to close briefly with what I call in my book a model of radical financial innovation. And here I'm sounding left-wing, but I don't mean radical in the sense of left-wing. I just mean fundamental. And I argue that in history, we have seen a number of major changes in our financial institutions that were truly radical. And when thought for ex ante, they seemed impossible. I'll give 2 examples. One of them is life insurance. Life insurance was invented in the 1600s in London, and it was really made possible by some academic, where I shouldn't congratulate our professors, but I don't know if they were professors. They were probability theorists. They invented this whole idea of probability theory. And then someone in the 1600s said, hey, we should develop life tables. And then we can create an actuarial science, and we can create a whole business that manages the risk of early death. That was beautiful, but life insurance did not come into its own until the 19th century. Few people bought life insurance. It was just a few intellectuals. The problem was people couldn't understand the concept. A few intellectuals understood it. Most people didn't. And so let me come back to the risk as feelings hypothesis. Most people do not conceive the need for life insurance. You have to be sold it. And you will not, in the 18th century, there was hardly anyone who would say, I need life insurance. I'm going to get on my horse and ride into town and find someone who will sell me that. Now, they would get on their horse and ride into town for many different things, but not life insurance. You had to be sold it. And so the advances are in marketing and in packaging, and this developed over the 19th century to overcome resistance. And now everybody has life insurance. Incidentally, we don't even think about it. It's also an obsolete institution. It used to be very expensive and a serious thing to buy because the life expectancy was 45 years, and you had these young children that you had to worry about. It was a big decision to buy life insurance. Now with the life expectancy up, something 75, 80 years, it's cheap. Nobody even thinks about it. We just buy it in a reflex action. But it's an obsolete institution, mostly because it's not addressing the big risks that we face today. It's not early death. The big risk is the risk of economic change that can affect all of us in unpredictable ways. So, and finally, the final example is Social Security, which came in Germany in the 1880s, and of which our current system in the United States is almost a carbon copy. It is really remarkable. It took us until 1934 to adopt it, but then we're just stuck with the same system that was invented in Bismarck, Germany, basically the same. But anyway, I'm thinking of it as a very important system because poverty in the elderly would be an extreme problem if we didn't have it. It solved the problem. That's why everybody in the world adopted it. It was all copied from the German model. But I wanted to think about what made it possible in Germany in 1889. And this is my last point. I think that it was information technology. And we don't think of the 19th century as a century of rapid progress in information technology. But in fact, the 19th century was a century of stunning progress in information technology. And it was simple things that we take for granted, not computers. It was the invention of cheap paper. They invented paper in the 18th century was made out of cloth by hand, and it was so expensive. I think someone told me that a subscription to a newspaper in 1800 brought up to today's dollars would be about $9,000 a year. And so it was because paper and printing were so expensive. So they invented wood pulp paper. They invented carbon paper so they could make copies. They invented printed forms. They invented filing cabinets. They invented a better civil bureaucracy. They invented a better postal service. It used to cost, to mail a letter in 1800 was something like Federal Express cost. So, and people weren't as rich back then. So the typical person would only get 3 or 4 letters a year. So what people doubted in 1889 when they set up the Social Security system is, I don't think the German government can do this. You're telling me, the system is, you're going to be paying regularly to the government your Social Security contributions for 40 years, and they're going to keep records for all those years. And when you retire, they're going to still have those records. And someone is going to compute a formula and then send you a regular monthly check. I don't know if it was a check, how they did it, but people doubted that it could be done. It would be so expensive to do it. Well, it would have been practically impossible in 1800. But by 1889, it was just possible, and then it happened. So I think information technology drives these things. And now, in 2003, we are so vastly ahead of 1889 information technology. I think it's time for us to rethink all of these institutions and bring financial theory into better focus and better application.
Bob, a comment and a question. The comment is you didn't mention something you mentioned to me on the phone the other day, which was one of the critical inflection points in making life insurance acceptable to the masses, which was a framing issue in changing the name of life insurance to life insurance from death insurance.
That's right.
So in other words, they were always trying to sell it as death insurance, and nobody wanted that.
That's right.
The option.
Right. Because someone said, well, no, it's life insurance. Oh, yeah. Well, I definitely need that. And which is nothing but framing. You, of course, have a knack for making provocative statements, and you made one today in your op-ed piece, which was, you talked about your inequality insurance, and which the idea is sort of you sort of freeze tax rates at a current level of inequality indexed to where things are. But then you sort of went on to say that, projecting out into the future, that the societal risks going out is that this could really prevent some very, very severe disruption if this trend of further pronounced inequality were to continue and accelerate, possibly ending, quote, even in violence. What do you think some of the societal costs are if some of these ideas don't get adopted?
Well, I think the risk to inequality is maybe the most important national issue today, and it's not talked about. Well, it's talked about, but it's not talked about actively. So, as I say in my article, in 1970, the bottom 40% of American families earned 18% of the national income. By 1998, it had come down to 14%. So it was a downward trend. So the bottom 40% earned 14%. If we extrapolate this trend, it won't be too many years before the bottom 40% of families are earning less than 10% of the national income. And my question is, it's not going to be because these people suddenly got lazy. It's going to be because of something like foreign competition or computers replacing jobs. So like, do we want that to happen? And if it does happen, I don't think any of us wants that, because it would make for an unpleasant society that nobody wants to live in, I think. So that's why I say this is a Republican proposal, that we should do something about this. And if I answered your question.
Yeah. Let's take some questions. Paul.
listening to the discussion, it seems like the actual application of this seems to depend upon the accuracy of the analysis and simplicity of input. So the two examples which were used by Mr. Dorsey and Mr. Taleb both involve very short-term testable phenomena, interim surveys or finding pockets of empirical irrationality within a generally rational framework. Is the problem on some of the broader applications of this kind of garbage in, garbage out problem? The further you go out, the more uncertain many of the inputs, the more complex the inputs, the less useful this type of analysis is? Does it inherently have a short-term bias in its application at this point? How ambitious should people be regarding it in the immediate future?
Oh, yeah, go ahead.
Say, what you're really bringing up is what I call the issue of scale and context. Someone says, bullish on the market. Well, for how long are you bullish? What is the scale and context of that thought process? And this really comes a little bit back, in my view, to what Hunt Taylor was talking about, which is if we look at financial history, we do see these big extremes in asset classes. Gold goes down for 19 years, stock market goes up for 20 years, et cetera, is why can't we, and I think in some cases we can make inferences about much longer trends. So for instance, but that is not always, in my view, it's not always possible, but sometimes those inferences can have what I would call a high probability. For instance, the early 2000 stock market high had many characteristics that, in my view, suggested that a 20-year bull market was ending, and the inference was that was going to be a poor asset class to be in for some considerable period of time. But it's not always possible to do that, to make those kinds of inferences. So, for instance, where are we, for instance, in the euro, at the moment? It's hard to say. So I think that there are certain scales and contexts that are predictable, and some are not. And the great difficulty, of course, is knowing what you know and knowing what you don't know about a particular scale and context.
I have no comment.
Okay.
Well, I just say I think behavioral finance has applications all over it's one input to judgment, and I think people who take account of it ought to, in the long run, make more money in portfolio management. But I think they've already been applying it intuitively. It's what we've got with all this academic research is just a better refinement of it, and it makes you maybe more confident in those intuitive judgments.
Steve, I'll call on you, but only if you promise to confine your question to less than 11 parts.
First, a brief observation. Can I use the top?
Sure.
I'm going to take a chapter out of Nassim here. One of the interesting things that I learned from a very smart gentleman, a very simple man actually, a long time ago, was this equation. The simple gentleman was a Merrill Lynch broker. If I'm not offending anybody. And the equation went like this. I over E equals R. And the corollary is E over I equals IR. And when I first put it up at a presentation, I had a lot of sharp people in there and say, okay, this is elasticity, this is emotions. Mr. McCarthy forgot an R, internal rate of return. I said, no, it's much more simple and actually a lot more complex. It's about the human equation. If your intellect holds sway over your emotions, you act rationally. If your emotions hold sway over your intellect, you act irrationally. Probably appropriate for this study. And my question is this. One smart behavioralist said this time is different. His name was Benjamin Graham. This time I think maybe distinct. You comment about the translation effect in terms of the emotions of the monetary and fiscal policy makers in this country, many of them Republicans, of course, and the information overload we have. Because in your example, Dr. Shiller, you had a big translation gap between the information flowing from London to town. You had a big gap. Now you're right in your face. So how does that affect behavioral finance, emotion, and the translation?
Well, I said difficult. Are you asking about new technology that brings things up, like the internet is bringing things right to my face?
And how does that affect
Yeah.
behavioral finance? I mean, is
Yeah.
the information overload now different and changing behavioral
Right. Well, I mean, information technology changes was part of the bubble that we saw. All these news media proliferating, and we saw these special business channels, and that was part of the thing. It gave, you talk about mimetics. The idea is that ideas are like viruses. And so if something increases the contagion rate, this is why influenza is a winter disease, because we tend to be indoors more, and it's spread by coughing and vapor from people's. If you're indoors, the contagion rate goes up, so it's enough so that the disease then can start proliferating. If it's below the removal rate, the disease can't expand. But it's the same thing with memes, as you say, or ideas. And so suddenly the new technology increased the contagion rate of enthusiasm for the market, and it ran for a long time until it reached a. So that's an example. But technology continues to change, and I think it's going to create other surprises like that. With no idea what it's going to. I have no idea what it's going to do next in terms of market behavior.
Yeah, I just want to follow up on this corner's theme. It does seem that one of the key problems in fine-tuning and bringing this point to the mainstream is defining the optimal scale, time scale, emotional cycle scale. And what I would like to see the panelists take a shot at is if you had to pick one time window to trade, so maybe the professor's not involved, but you've got the Stevie Cohns of the world who are doing the optimal cycle of 25 minutes to 3 hours. And you've got the sociological cycle of social security that go for 100 years. If you had to make maximum annualized return vis-a-vis maximum annualized noise or a Sharpe ratio, what would you pick? 20 minutes, 2 weeks, 10 days?
So you're asking the traders?
Yeah.
Yes. Okay. The matter of scale. Okay. The matter of scale. No, the matter of scale is very complicated.
20 years for personal.
The matter of scale is a very complicated one because and one that in a catalog of biases is quite significant for one reason. Your brain one interprets what you just saw as being statistically significant. Your brain two will use a Sharpe ratio to say, well, if we annualize the Sharpe ratio, it gives you a Sharpe ratio of 0. Okay. Whereas that's your brain two. Okay, your cognitive. So you have. In Fooled by Randomness, I explained that I try to insulate myself from my brain one by preventing myself from seeing anything that's below 1 daily sigma. Okay?
Below what?
1 daily sigma.
1 daily
Sigma. Yeah, I give the example in my book of a dentist, and that dentist was trading by mail. Okay, he would trading by mail, gets monthly statements, and it was great life because he was a good trader. Now that he discovered the internet, and he resigned from dentistry because it's too boring. In fact, it is, and he goes up to his attic and starts trading from his attic. Okay, now what does he have? Live prices on the screen. Costs him $25 a month, and he has live prices on the screen, and it's going to be misery for him because although he's a great trader, and let's assume he has a Sharpe ratio 1.5. Okay, over any second interval, his probability of making money is close to 50%, converges to 50% over any second, and aggregates. But his brain and his emotions don't know it. So what I suggest is that a dentist revert back to using the conventional mail, perhaps email to put his orders, all right, and read his statement monthly, and that would be a much better life for him. A lot of traders burn out because of the emotional impact of brain one dictating, your up and down emotionally from things that are statistically insignificant. And I give an example in my new book. I have an example of a real example. Here, there is a statistician jumping up and down for making money, and I computed it, and it was 0.1 of a sigma. And he was like, he was very happy. Okay, and I said, okay, if I called him up and told him, hi, this is Dr. Talebsky from Lodz University. I have this observation. Can you compute the statistical significance? I think it's very important. He would tell me, did you get your degree in a fortune cookie? Okay, that same person, okay, who's capable of computing probabilities, or jumping up and down, okay, over an information that was statistically insignificant. And that's the problem of scaling. We should stop people from trading. Well, actually, they stop by themselves. Trading over short term, they just stop. Okay. Now, some people who are market maker benefit from bid-ask, which represents a very small, necessarily a very small segment of the investment community, very, very small, may benefit from being involved at high frequency data. I was a bid trader, of course. I was interested in high frequency data, but not as an investor.
I wanted to address your point too, which is, I think from my language, what you were asking is what is the optimum trend duration mode of an investment to make money?
If you had to pick one.
Right. Yeah, but I think that's the difficulty, is that it's a relational and a provisional question that is really based on the opportunities the market is presenting. And it has to do with the degree of disequilibrium at any given time in a market situation in terms of where the opportunity is. By disequilibrium, we might also say the error that the market is making. And sometimes over a month, the error of the month is enormous and there's a big opportunity. By the same token, getting back to the question of scale and context, probably the error of the decade in early 2000 was buying stocks and selling gold. That's a greater context. And the reason I get to this also is that even from a
Selling stocks and buying.
Yes. Thank you. From a memetics point of view, we're talking about viral propagation, information cascades, is there are always phases in markets where there are enormous moves, and those moves take place in relatively short periods of time. So I don't think there's an absolute time frame that we can bracket. So that's a non-answer.
Professor Shiller, you talked about selling insurance or incomes and large social income levels, if you will. Two of them you mentioned. Insurance, as Nassim talked about, is the negative gamma left skew distribution. So in one case, with buying a put, reinsurers distribute the put to everybody. Who do the reinsurers sell to? Investors who invest in reinsurance company. The same individuals who are buying the put also selling the put. That's a question. So help me understand that. That's number one. Number two, the same concept of life insurance came because it was small life insurance people, business. They take the premium, invest in something else, and therefore they can make a higher return. If you're also insuring investment properties, who's going to sell the insurance? Where will they reinvest if the market in this process becomes more efficient? Therefore, you've got a place where to invest the money, and B, the negative gamma that Nassim is talking about is redistributed.
I've been buying calls on the income, out of the money calls on income, everyone here, because odds are you're going to underestimate that call.
Yeah.
I'd be buying a call on your income.
I know, but
Out of the money call, because you're going to misprice it.
And I'd like the puts on analysts.
yeah, I didn't interpret that as a behavioral finance question. That sounded like a conventional. Maybe I didn't understand the question. I wrote a paper a couple of years ago in the American Economic Review about the full general equilibrium model of the world, about where the risk goes. And my co-author and I estimated the welfare benefits to spreading the world's risks around. So ultimately, all of these are institutions to make it possible for people to spread their risks to some other party that doesn't correlate with it. And so maybe I'm not understanding your question.
I was talking with implementation. I'm an empiricist. I want to see how you implement it,
and then
how you distribute this risk. Where are the lack of correlation between investable assets? Everybody buys the same.
But it wouldn't be the same. The idea is that different income flows that we are not marketed today at all, like the GDPs of countries, are not perfectly correlated with each other. Moreover, there's occupational incomes, and those are not perfectly correlated. So you can have dentists or analysts or whoever sharing their career risks with people in other careers. And so ultimately, it is doable. There's no adding up problem. You have to look at the this is pure theory with no behavioral component, but it really reveals where the big welfare gains are. And the big welfare gains, I think, are in these untapped, these risks to people's personal livelihoods that are not traded at all now. And so there's definitely risk to be gained. Now, we don't have the institutions to do it, but once we have markets for these things and we have insurance companies handling them, I don't see why we shouldn't have huge welfare gains.
Rosalie.
Continuing toward the macro theme, we've been in a world, in the West at least, in which a huge amount of people's future pensions have switched to a defined contribution scheme, in which it seems to me one of your behavioral finance principles is operating perfectly. People don't really think they're not going to have any money at retirement, so they don't really save. So we have this looming, huge macro problem that is generally sort of known about at policy levels, but isn't being dealt with. Is there some way that the concepts of behavioral and traditional finance can be combined to help our politicians solve this, whether they are Republicans or Democrats?
Yeah, I think there's a number of specific proposals. Let me mention one that Dick Thaler, who's my colleague at Chicago, I'm not at Chicago, that's where he is. He has something called the Save More Tomorrow plan. Have you heard this? And he's starting to implement this at companies. The idea is you tell your employees, we have a new plan, and what it will do is if you sign up for the plan, you will get nothing to happen today. But as your paycheck rises, as it does normally through time, all the extra will go into saving automatically. You won't ever get it. And so...
you're selling a call on your income.
Well, yeah.
People sell calls.
You're not
People
selling it to
sell
someone else.
options.
You're just putting it in your own account. But and then you can cancel this at any time. But it turns out a lot of people will say, sure, I'm not saving. The thing is, polls show that most Americans will tell you they're not saving enough. They know they're not saving enough. So you present this plan to them, and they say, sure, I'll sign up for it. And they don't resign, even though at any moment they could resign. So it's a self-control mechanism. But that's one example of the kind of... Now, as far as government, the government really, I think people recognize it ought to encourage saving. And so that there's things like this that they can do, I think. Everything has to be designed with a behavioral perspective.
Well, the one I want to see is I want to see George Bush do the State of the Union and say, hey, we just did a GDP swap with China. Over there. You, sir.
I'm intrigued by your very positive outlook for technology and its role, information technology, but also financial technology. And your allusion to the Wright brothers makes a point that I've been thinking a lot about, which is even 100 years ago, technology was, as you say, driven by the invention. The Wright brothers finally found an engine that would be light enough and powerful enough, and hence the airplane, which had obvious needs. Today we're in a situation where technology seems to be moving so fast that the uses of that technology are scrambling to catch up. We have capacity, capability to do things that aren't being used at all, whether that's in computers and so forth, but also I think about it in terms of financial technology, the use of swaps, derivatives, etc., to do the kind of risk sharing and risk management that you talk about has been now around for, let's say, a decade at least, in terms of its real sophistication. So we're now in a mode of, and you have regulatory issues, and you have usage issues, and you have understanding issues of what this technology can do to overcome. So it's a little bit different from the old model in the sense that there's a lot of ways that we could go to catch up with what the technology has to offer. And I wonder how that plays into your view of the future.
Yeah, well, I can't predict the future. What I'm doing in my book is just trying to look at the big risk management opportunities and imagining that the details will somehow be worked out and we'll be able to exploit them. But that the theme is that invention is a process of experimentation and application of the thing. I may be repeating myself. The thing that makes an invention work is often so subtle that you don't even see it. But you see other people successfully doing something, and then you copy it everywhere. So we're going to see lots of surprises in the next 10 years, where things that you may vaguely have thought about, but now it's happening, and you don't know why. But it has to do. So I like to think of eBay as an example of an amazing progress that now everybody is auctioning everything off. I think that is a metaphor for what's going to happen in a lot of other areas, notably risk management.
Folks, it's past the witching hour and time for us to get back to our day jobs.